Hey guys, Daniel here. In this video, I wanted to go through with you my screening process when looking for companies trading substantially below their tangible book value. So in this, we're going to go pretty much, starting with the A's, so to speak, for the companies that meet the initial quantitative part of my screener, and we're going to go through them one by one. And then just move through the companies basically very quickly, and adding them to a watch list if we determine them to be of interest to us. So we'll start here basically on Y charts. My first thing that I like to do, I just like to set the exchanges to the Canadian exchanges as well as the U.S. Exchanges. They're the major U.S. exchanges. I exclude generally the Neo exchange because for my purposes, it's not really relevant since those companies are covered on the U.S. exchanges anyways. In terms of filters, we're going to be looking at companies trading below tangible book value. So something like from 0.1 all the way to like something like 0.75, since beyond that it wouldn't be much of an interest to us. And that narrows down our universe to about just over 1,000 securities. We can remove duplicates, which will narrow it down to about 1,100. I also like looking at what the 5-year median price to tangible book value is. The reason is I'm not looking for companies that are trading for below their tangible asset value for tremendously long periods of time. I want to see that they've demonstrated that most of the time they're trading at a higher price level, let's say. So price to tangible book value, I can look at like the 5-year median. We want to see probably that it's greater than like 0.9 or something like that. That shows that there's at least a history of the company being fairly valued most of the time. Some other things that I'll look for in my screener, I want to exclude certain sectors. The sectors that I typically exclude right away are financial, so banks and insurance companies, just because they're definitely outside of my circle of competence. I also tend to exclude mining companies now, or basic materials. So something that's important to keep in mind when I do this, I don't run the same screeners all the time. So I have a number of different screeners. Sometimes I just play around with different numbers and different metrics. So this is just one example of something that I would do. But don't take it too seriously in that it's not like I run this particular screener all the time. Sometimes I run other types of screeners. I might run other parameters. Basically, this is just to give me one narrow snapshot of companies that have a higher potential of trading substantially below their what we can consider to be a fair price. So another column that I would put in here would be something like debt to EBITDA. Just to give us not so much as a filter, but just to give us a sense of what that balance sheet is looking like in terms of the debt that they have. So if we sort by companies that have a tremendous amount of financial debt, we're probably not going to be too interested in these companies here. To start off with, and so you can choose to eliminate them. You can choose to hold them, and or hold them within the screener, and then decide what you want to do later on. Another metric that we might look at, not so much from a filter point of view, but just from a metric standpoint, or we can actually apply it as a filter now, would be something like the return on capital. Maybe like their 5-year median, we want to see that it's positive, so at least we know that they're on the average year generating some sort of positive return on capital rather than just burning through money. So we narrowed it down to 50 equities here. I mean, that's actually quite low. So maybe our screeners is a little bit too tight right now. But we'll just leave it for now. You know what? Why don't we remove this one so we get a little bit more range in terms of what we're looking at? We'll sort by their symbol, and then just go through basically all of these, or we won't go through all of them, but we'll go through a good number until basically I decide to end the video. But we can start, for example, ADES, Advanced Emission Solutions. So when I open it up, the first thing I look at is what the company does, because I want to have a good understanding of what the company does. Basically, if I can't understand how it makes money, I'm not interested. Provide solutions to customers in coal-fired power generation, municipal water, other industries through proprietary emission control and water purification technologies. Yeah, I don't know what that means. Avangrid, networks and renewables, 8 electric. Okay, utilities. All right, that's interesting. I understand utilities and I understand renewables at least a little bit more. Okay. The next thing that I'll look at is just I take a glance at the price history. I'm not too interested in obviously, like, I have no care about technical analysis or any of that, like, but I am interested, like, okay, this is a utility company. I want to see what the price was like. I want to see the dividend is a little bit interesting to me, but again, I got to look at it within the context of everything else. Generally, I'll scroll down and I'll look at, okay, what was the revenue looking like, the balance sheet, and the cash flow over the last few years. And then once it gets through that basic level, then I'll move on to look at the financials. So, just looking briefly over at the revenue here, gross profit. Net income is positive every quarter for the last few quarters, which is quite interesting. I'm dealing with quite high EBITDA margins as well. Okay. So basically when I'm looking through this, what I'm looking for is for a reason to say no and a reason to just reject the company. Let's go to the balance sheet. Let's see quarterly current assets, relatively stable. A lot of that assets, okay, so a lot of it is in long-term assets, mostly in properties, plants, and equipment. So total assets right now, 42 billion. Most of that is in long-term assets, very little current assets. Current asset to current liabilities. So they're right now, their current ratio is below 1, something to consider. So their current liabilities exceed their current assets. Most of their current liabilities are accounts payable. In terms of cash, and they got a good amount. They got very little cash, quite a bit of inventory, and a lot of receivables actually, and a lot of other which we have to look at the 10Q to see what specifically that is. Tangible book value here is at 16 billion. Long-term debt 10 billion. Let's pull up the 10Q, see what's going on here. Oops. So, let's leave it. It's interesting enough to research later. Sorry. So the tangible book value was 17 billion, if I'm not mistaken, 16 billion, and the market cap. Market cap was 12 billion. Also be interested in the earnings power, so we can look at something like their free cash flow. And yeah, they're burning more and more money every single year. We'll have to continue to investigate and see exactly why. I just want to take a quick look at the retained earnings. So retained earnings. Okay, they have positive retained earnings, which is okay, at least. So, you know what, we'll just add them to the watch list and then decide later on what we want to do. So let me just add them quickly to my watch list. Okay, I'm already watching them. That's good. Okay. Great Ajax. Next. Mortgage loans, not interested. Air Lease. Oh. So their financial debt is 11 times their EBITDA. I'm just not interested probably. So they lease aircraft. We'll just take a quick look at their balance sheet just to see what's going on here. Balance sheet wise, their shareholders' equity 7 billion, tangible book value again 7 billion, so most of it's intangible assets, but their long-term debt far exceeds their equity by quite a substantial margin. Obviously looking at how the debt's structured is important as well, but if you're talking about them having like whatever it was 10 or 11 times their EBITDA in financial debt, then like one way to lose money is just buy companies that are so over levered like that one there. So it just doesn't interest me. Real estate investment trust doesn't interest me. A-Pulse, centrifuge machines. Okay. Again, bordering on the edge of my circle of competence here. So we would need a wild margin of safety for me to even consider it. And generally, I'm just doing this for fun more than anything else. I don't think I'm too interested in this company. 6 million tangible book value. Number of shares. This is also something to look at. You want to make sure that they're not diluting their equity. And not too much long-term debt. That's good. What about the earnings power? Net income has been positive. That's good. Do we check retained earnings? I don't know why I always forget to check the retained earnings first before leaving the balance sheet. Retained earnings is positive. And when retained earnings is larger than the market cap, that's usually a good sign as well. Well, it's about the same size, $5 million market cap. 5 million market cap. And what was that tangible book value again? $7 million. Not enough of a margin of safety, right? Yeah, and here we can see the price of tangible book value is only like 0.73, so real estate, no. Realty investors, I mean, again, it has to have such a margin of safety for me to even be interested. Okay. Let's check it out. So I like seeing, net income is positive. That's good. Diluted earnings per share. They don't pay out a dividend. The shares outstanding has remained relatively stable last few quarters. Balance sheet wise, 400 million current assets, 600 million long-term assets, $1 billion total assets. Current liabilities only 230 million, so they got good short-term coverage. Shares again remain stable. Tangible book value has increased quite a bit over time. So this is always interesting. Like, look here, from this quarter to this quarter, their tangible book value doubled. You got to ask yourself why. So that's important to read the balance sheet over about. And they also managed to pay down quite a bit of their debt. So, Okay, we'll add this to the watch list to read more about later. AXT. No. Becker Milk. So this is a company I'm actually currently looking at. Seriously. Of course. I think I drove the price up actually because I spoke about it to some people, and so. Yeah, but it is what it is. Because it's not a company that. This is a company where you tell people about it. I should really stop talking about it because I should have bought in before I told people. But I think if you look at if you look at it quite carefully, at least before down here, there's a bit of a better margin of safety. It was quite an interesting company to me. They own about $30 million of real estate, and their market cap's $25 million. They basically have no debt, but just not enough of a margin of safety for me to do anything right now. So let me just. I'm pretty sure it might not be on this watch list, so I'll just add it. Okay, Big Five Sporting Goods. This is another one that's interested me a little bit. Their operating income has fallen terribly, as have their revenues, and their net income is still positive, which is quite surprising in the last quarter. I'm surprised that this company is still able to make money and still paying a dividend, although we've got to obviously do research in terms of what that's going to look like moving forward. Balance sheet side of things. So current assets, you can see here, have been basically being eaten away. So total assets 674 million. Their current coverage is good, and their Shares are not being diluted, which is good. Their tangible book value is showing a little bit of a sign of falling the last few quarters in a row. So that's something that definitely you want to watch out for. You don't want to try and jump in before you want to see that the tangible book value is relatively stable over time. One thing that I do like looking at is this fundamental chart where I try and plot the tangible book value along with the market cap. We'll get the revenue off of there for now. So you can see that actually the price, what you want to see is that the price shows some sort of resistance to the tangible book value. Then that means that that tangible book value, at least historically, had some representation of a fair price for the company, or a minimum price that makes sense for the company. So in this case, where it's trading at below half of its market cap, that's quite interesting to me. Or it's trading at half its tangible book value. That is a little bit interesting to me. So we'll add this to the to the watch list if it's not on there yet. All right. Energy. So just quickly check here. All right. Oil and gas. Let's take a quick look down here. Revenues have fallen. Correspondingly, net income still remained positive, which is interesting. I guess they were dealing with fairly high margins at this point. Balance sheet side of things, their equity has gone down a little bit, but okay. Let's take a quick look here. Shares not being diluted, which is good. Actually being bought back. Dividend paid out. EBITDA margin is quite high actually. But what am I doing? Where's the balance sheet? So shareholders' equity has remained relatively stable. Long-term debt. 2.8 billion tangible book value, selling for 1.4 billion. In terms of its earning power, so we're talking about basically a completely unpredictable earning power. So yeah, no. Blue Metric Environmental. Yeah, I don't know what that means. No. Bonterra Energy Group. Well, we can just look here quickly. So market cap is 178 million. It's interesting to me. So keep in mind, what we're looking for is for companies trading substantially below their tangible book value as a first level screen, but then obviously afterwards we have to see that that tangible book value is actually real and what it's specifically, and we do that by reading the 10Ks and the 10Qs and so on. Or in this case, the quarterly reports. Yeah, so, and we just continue down the list. Basically, this is what I do almost on a daily basis. And then when I find things that are interesting to me, like things on my watch list, let's say, then I investigate them more in depth. I want to look at the news. I want to see what's going on in terms of, what people are saying about the company, although most of this is complete nonsense. I want to see if there's anything interesting out there about the company, what people are saying about it, if anything. Usually they don't, because the companies that I'm looking at, if you look at their market cap, the majority of them are under 100 million. So very few people are going to be actually, a lot less people are going to be looking there. So yeah, just this is how I get started in terms of my process. And again, this screener, don't think it's magical or anything. I do different things all the time in terms of my screening process. Sometimes I might go on an earning power basis. I might look at like the PE5, like under 15, for example, is starting off. So things like that. Like this this screening process is not it's not fixed for me. I always try different things because I believe if you look at only one screener, like if you look only through one screener, then the chance of you finding something is going to be a lot less than if you have multiple different screeners that you employ. So yeah, I hope you enjoyed the video. If you have any questions, ask them in the comment section down below. Thanks.